NIO told stock market investors in a quarterly conference call with analysts that they plan to be break even by the year 2026. Now, that would be a huge improvement for a company that's been losing significant sums of money on the bottom line for several years to reach break even point in 2026 on a full year basis, not just for one quarter. So that would be a big inflection point for a company that just hit another inflection point in being cash flow positive. Those two are different, and I'll explain what those differences are in this video. Let's take a look at this announcement and what it could mean for NIO stock investors.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, here you have Bin Lee saying that in regarding the company's profitability, the entire company to use 2026 as the timing where we will achieve the full year break even. That means revenue will equal expense and they will be break even for the year at the least. Maybe they do even better than that. The difference, as I highlighted in the beginning of the video, the company did reach positive cash flow, free cash flow in the latest quarter. The difference between cash flow and profit are non-cash expenses. Businesses oftentimes have expenses that are not cash-based. What are some examples of that? One is stock-based compensation, where a company pays employees in stock options or stock grants. And this is not a cash expense for the company because they are giving the employee stock options or stock grants. They're paying them in equity of the business. They're giving them a piece of the business instead of giving them cash as a payment for service. And so they have to account for that on the income statement as an expense, but it's not a cash outflow. So there can be a difference arising from just that difference alone. Another non-cash expense is depreciation. Companies like NIO might spend $1 billion on a manufacturing facility, and they usually pay all of that money up front in the first year or two in building the manufacturing facility. And then for the next 10, 20 years, as they use that facility, that's not a cash expense going for the manufacturing of that facility. But the way accounting has you recognize that is instead of taking a $1 billion expense up front, the accounting departments have you spread that out over 10 years or over 30 years or over 5 years, depending on the type of asset, right? Each type of asset has a depreciation schedule associated with that type of asset. A manufacturing facility will have a longer timeline for depreciation than would a computer technology, right? If you buy 10 computers, that will have a different depreciation schedule than if you have a manufacturing facility. So because of those differences in timing of the cash flows, profit and cash flow will usually be different for most companies worldwide. The more important metric is cash flow, right? Because that's what determines if the company will need to go back to investors and ask for more money. If they have the cash flow, if they're positive cash flow, that means they don't need to go to investors and ask for money anymore if they're sustainably positive free cash flow. Whereas with profit, you can show positive profitability and still have negative cash flow, and you're still not a self-sustaining business, and you still need to go back to investors and ask for more money. So of these two metrics, I regard free cash flow as more important than profitability, but combined, they are both important, and you'd like to see companies make progress on both fronts. NIO's management went on to say that it's true that NIO has been in the European market for a while, and its overall operations and performance didn't really live up to our original expectations. So that was a letdown for NIO stock investors who were expecting the company to do really, really well in the European market. It hasn't done so well. And now with the tariffs in Europe, its selling price is basically on par with the price of a Porsche. In that case, its market is becoming more and more limited because buyers, if you compare a NIO with the Porsche, in very many instances, buyers would rather have a Porsche than a NIO. However, starting next year, you will see that Onvo and Firefly products are becoming available in more and more countries and regions. And remember, the Onvo and Firefly are lower priced brands aimed at the broader market, and so that could help facilitate sales in outside markets that might be more price sensitive, and that way NIO can get increasing sales outside of China with these newer brands. At least that's the hope for NIO management. Now, that remains to be seen if these other brands will catch on in outside markets, or if 2 years later we're going to hear the same thing with these other brands as we're hearing right now with the NIO brand. Will management come back to investors 2 years later and say, I know we have been in these markets for a couple of years and sales have been disappointing? Or will they come back and say, we've been in these markets for a couple of years now and we're thrilled to see how sales are progressing? That remains to be seen. In the meantime, NIO will need to speed up their infrastructure spending and their cost structure so that they will have the power swap stations and other facilities built in advance before they actually launch these newer models into the markets, because that is partly what drives demand for these models. When customers see that they are available, all of these power swap stations, the more available they are, the more interested buyers will be in these cars. And so in the meantime, there will be a higher loss on other business. So in other words, what management's saying is in 2026, we expect to be break even. But between now and then, things are going to get worse before they get better, is what NIO's management team is essentially telling investors. And investors have been very patient with NIO as the company has spent aggressively for their growth ambitions. And investors are hoping that the progress continues. They did hit positive free cash flow, which was a huge positive. And these launches of the lower priced brands will increase unit sales for the company, get more people into the NIO ecosystem. And if these customers are happy with these brands like Onvo and Firefly, if these customers, some of them, as they go through life, their income will increase. And if they have a positive relationship with the NIO brand, they might upgrade to the more expensive NIO branded products up from the introductory products of Firefly and Onvo. At least that's the hope for NIO's management over the long term. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.